Welcome to Off the Clock, a podcast by Procino-Wells and Woodland, where we take a team-centered, family-focused approach to serving the estate planning and elder law needs of our community in Delaware. I'm Katie Bull, one of the attorneys here at the firm, and I'm joined today by Kyle Banks, an investment advisor with PKS Investment Advisors, LLC. We are excited to discuss grandparents today and strategic opportunities for grandparents to help their grandchildren save for future milestones. Let's get started. Hi, Kyle. Thanks for being with us.
Hey, Katie. Thanks for having me on today.
It's a pleasure. Before we go ahead and get started, do you mind introducing yourself to our listeners today?
Sure. So I'm an investment advisor. I work for PKS Investment Advisors. We have offices in Lewis, Delaware, as well as Ocean City, Maryland, and Salisbury, Maryland. We provide both investment advisory and financial planning services. And we're affiliated with PKS and Company, PA, which is an accounting firm, and they operate out of the same three offices as us. And our approach at PKS is we try to coordinate with our accounting counterparts to integrate tax planning and financial planning all under one roof.
Awesome. Well, thank you. Kind of want to switch gears a bit. Today's goal, right, is talk about grandparents. I think our offices are similar in that oftentimes we have older clients who come in and they want to strategize over their planning goals. Kind of with that is a lot of times our clients have grandchildren that they adore and that they want to support. So in that same line of thought, I want to talk specifically about grandparents who want to help save for education expenses. Specifically the 529 plan, and other vehicles that a person might use to save for their grandchild's education expenses. So if you don't mind exploring that for us, Kyle, that'd be great.
Sure. So you do have several options that you can use for this. First one I'll talk about is what's called a Coverdell Education Savings Account. You'll hear it shortened to ESA. And with these accounts, contributions are made into these accounts. The earnings in these accounts grow tax deferred, and then when you make qualified withdrawals, meaning withdrawals for education, those withdrawals come out tax free. So with these accounts, one thing that you need to consider though is you're limited in the amount of annual contributions that you can make per beneficiary, and that amount is only $2,000 each year. And what that means is that that's $2,000 that can be given on behalf of one beneficiary from all sources, right? So if grandparents, parents, really anyone wants to contribute to that account, combined, that total has to be limited to $2,000. So another account you could use is what's referred to as an UGMA or an UPMA. So this is a custodial account. So it's an account for a minor, and a trustee manages that account, and it's managed until the child reaches the age of majority. And that age of majority is either going to be 18 or 21, and it varies on a state-by-state basis. So a couple things to keep in mind if you do use this type of account is it does not have the tax benefits that you see with a Coverdell ESA or that you see with a 529, which we'll talk about in a moment here. But a couple things to consider are that account, once that child reaches the age of majority, they fully control those funds. So at that point, if the funds were earmarked for education, once they reach that age of majority, the child can actually use them for whatever purpose they want. It does not necessarily have to be used for education. So there is an inherent lack of control with this type of account. And then the other thing to consider if you use that account is for financial aid purposes, it actually counts as an asset of the child for FAFSA. So it's more punitive than if it were counted as like an asset of a parent. So that gets us to 529 accounts. And what 529 accounts are is they're state-sponsored investment plan vehicles that are specifically for education. And like the Coverdell ESA, contributions grow tax deferred, and then qualified withdrawals, they come out tax free. So what qualified withdrawals are essentially is tuition, room and board, books, any fees imposed by the university, things like that. So that's what are defined as qualified expenses. And with these 529 accounts, there's typically there's a menu of professionally managed funds that you can pick from for investing the funds that you contribute, and those will include age-based funds that essentially you select a target enrollment date for the beneficiary, and then the fund manager will manage that account accordingly, making sure that they're matching the risk with the timeline of when the child is going to attend university. Or you could just do a static portfolio where you essentially select, you select if you want to be conservative, if you want to be aggressive, or somewhere in the middle.
Oh,
So with
great.
that, the contribution limits of ESA and the lack of control with an UGMA, they really have made 529s kind of the preferred savings vehicle for education funding.
Sure. I think it was important that you made that distinction with the $2,000 and how it's not based on per donor, it's based on the beneficiary. And that kind of leads me to my next question. How do you typically handle it, or what do you advise, grandparents when they're not the only ones, right, that want to contribute to the child's education expenses? So parents, right, when they're thinking about also contributing, what should grandparents consider in this case scenario when parents are already having a 529 set up?
So this is where coordination of benefits becomes crucial, right? You want to make sure that you are working in tandem with the parents of your grandchild, just to make sure that things are being funded properly, right? Whoever owns the 529 ultimately is going to control the disbursement of the funds. So if a grandparent owns the 529, they will control when funds are distributed, versus if the parents controlled it, they would ultimately dictate when the funds were distributed. Up until recently, grandparent-owned 529s presented kind of an issue for financial aid calculations. So thanks to the FAFSA Simplification Act, that whole notoriously frustrating process of financial aid has been streamlined to some degree, and that includes the way it treats grandparent-owned 529 accounts. So previously, those grandparent-owned 529 accounts were any distributions from those accounts were reported as untaxed student income, and that reduces your student's eligibility for financial aid by up to 50% of that distribution amount, which is pretty significant. Now, students aren't required to report those cash gifts from grandparents or as contributions to 529 plans, and because of this, grandparents can really fully participate in funding their grandchild's education. It unlocks the ability to save quite a bit.
Sure.
And I think one other thing before we move on that's worth mentioning is that FAFSA Simplification Act is really FAFSA specific, right? A lot of private universities, they still use what's called the CSS profile, which takes a more holistic view of financial aid calculations and the student's financial situation. So a grandparent-owned 529 would still be counted in that scenario.
Okay, interesting. This is a lot of great information. We're still pretty early on in the conversation. It sounds like the timing of savings and distributions are critical. And so kind of with that, what strategies do you recommend for a grandparent who wants to maximize their flexibility, or say transfer the 529 to the parents later on?
Well, 529s are great because they offer lots of different options as it relates to flexibility. So, I guess firstly, we'll touch on ownership transferability, right? Some states allow for ownership changes before an account owner passes away, others don't. So if you do have a 529 plan, I'd recommend that you check with your state's administrator just to see, what that specific rule is. And while not all states allow ownership changes, what they do allow is they allow you to designate a successor owner, which is someone who would take over that account in the event that you passed away or become or are unable to manage the account anymore because of incapacity. And while you can't necessarily always do ownership changes, you can do beneficiary changes. So 529 plans, they are only permitted to have one beneficiary. So if you get to a place where one of your grandchildren goes through school, doesn't need all the money in the 529, you're able to go in and change that beneficiary. You're permitted to change it to another family member. And when you change the beneficiary to another family member, it generally does not have, it can be done without any federal tax implication, unless you're changing that beneficiary to a member of a lower generation. And then you could be triggering gift tax consequences. So if you are changing the beneficiary, I'd recommend consulting a tax professional, as they can kind of help talk you through the tax implications of that. The other thing that is really a really great and I think lesser known option with these 529 accounts, it offers a high degree of flexibility, is you're able to roll over funds in a 529 into a Roth IRA. So, let's say you get to, you say your grandchild doesn't end up going to college, or they get through their program and they don't use all the funds. Any leftover funds could be rolled into a Roth IRA, and it's as long as certain conditions are met. For instance, there's a lifetime limit to what you can roll over from a 529 into a Roth IRA, and that amount is $35,000. And any rollovers, they're going to be subject to the Roth IRA annual contribution limit. So for 2025, if you're under the age of 50, that's going to be $7,000. If you're over the age of 50, that's $8,000. So you just got to make sure that you adhere to that limit on a year-to-year basis when you're doing those rollovers from a 529 to a Roth IRA. And then additionally, there's this next one is a really big one. The 529 account has to be open for at least 15 years. So you can't open a 529, when the child is 17 with the intent of just rolling it into a Roth IRA. The account has to be long-standing to be able to take advantage of this option. And any contributions that are made within the last 5 years are not eligible for rollover. And when you're doing these rollovers, you have to make sure that the 529 beneficiary and the Roth IRA owner, that you have to make sure those names match. You cannot roll from one 529 beneficiary to a different Roth IRA owner. And when you make a contribution to a Roth IRA, you're limited to making a contribution in the amount of your earned income. So essentially, you have to have earned income to be able to take advantage of this as well.
Okay. I've heard about a special rule regarding the 529 plans contributions. Can you discuss the 5-year election rule?
Sure. So, I think in order to understand like that 5-year election rule, you have to quickly define, what the IRS annual exclusion is. So every individual has a lifetime exemption amount of gifts they can give. And that is 13.99 million for 2025. And what the IRS does is they say, okay, we will allow you an annual exemption of a certain amount where you don't eat into that lifetime exemption. So for this year, that's $19,000. So that's per donor, per year, per recipient. So yeah, you could give a grandchild $19,000 without incurring any gift tax implications. And conversely, a married couple could each give that same grandchild $19,000. So you could essentially do $38,000. So what that 5-year rule will allow you to do for 529 plans is it essentially lets you front load your 529 plan contribution. And you can basically make 5 years worth of contributions up to that annual exclusion in 1 year. So what I mean by that is you could basically do 19,000 5 times, right? You could do 95,000, or if you're a married couple, that is 190,000. So you could really put a lot in a 529 plan in 1 year. But a couple things just to keep in mind here is you want to be careful when you do this because any gifts you make in the subsequent years during that 5-year period, they're not going to get that annual exclusion, so they will have they'll count against your lifetime exemption in that circumstance. And if you pass away during that 5-year period, a portion of the contributions that you made into that 529, they're going to get clawed back into your estate. So really important just to make sure that if you do want to do this, consult with a tax professional, because you want to make sure that you're understanding the full tax implications here, as well as reporting it correctly, because the IRS does have certain guidelines about how they want it reported.
Sure. I've heard stories of, friends of mine or whoever having their grandparents pay directly to the institution. Um, for your purposes, are there pitfalls to this, right? When the grandparents just say, I want to pay the college directly, or what kind of strategies can you, I guess, encourage rather than paying directly?
Well, I think paying directly is actually it's a great strategy. I think it's underutilized, but it has such a huge advantage, because when you pay an educational institution directly, it does not count against your annual exclusion for gift purposes. So you essentially have an unlimited exclusion for direct payments to the university. Now, I think you just have to be really careful when you do that, because when we say direct payments to the university, it means a check that is addressed to the university. It is not a check that is addressed to your grandchild for the purposes of education. In the eyes of the IRS, they want to see that that check was made out to the university. But it really is, I mean, it's great because it doesn't eat into your annual exemption. So if you are someone who wants to be very generous and fund education and also provide gifts in other ways, you still have your annual exclusion intact to be able to do so. And the other thing I think you need to just be aware of when you do that is it only counts for tuition. So you can't apply it for room and board or books or supplies or anything like that, like you can for a 529. The definition of what counts for this is much more narrow than the qualified education expenses of a 529. So basically what that means is if you do have a 529 and you're a grandparent who still wants to, do the direct pay to universities, you just be strategic about, what funds you're using for what purpose, right? A direct payment to the university could be made, and then you could take a qualified distribution from a 529 for room and board. You just can't double dip. So you can't take a 529 distribution for the same expense that you paid directly to the university.
Okay. How does this factor in medical expenses? Is there any way for grandparents to contribute, tax-free to healthcare costs for their grandchildren?
Yeah, so actually the medical expenses have the same unlimited exemption if you pay directly to the healthcare that exists for the universities, right? So as long as you're making the check out directly to the healthcare provider, it counts for that annual exclusion. So again, if you want to be really generous, there are ways to be really strategic about, coordinating those benefits, paying directly to the university, paying directly to a healthcare provider, taking 529 distributions for other qualified education expenses, and then you're keeping that annual exclusion intact. So you still have the ability to give in other ways if you want.
Okay. Wow. As far as kind of actualizing this plan, do you recommend clients shopping around or using their own state's plan? And then how does that kind of come into consideration with states that have no income tax?
I think shopping around is important. You want to look at plan fees. You want to look at the investment options. You want to make sure that they they align with your investment philosophy, your personal investment philosophy, and risk tolerance. And you do also want to look at the state tax benefits. So it varies state by state, but some states do offer deductions for like in-state only plans. For instance, Delaware offers deduction for their plan, but this is something that you want to coordinate with your tax professional investment advisor. They can kind of point you in the direction of some plans that are available and might make sense for your situation.
Okay. Kind of got me with the 529 contributions thinking about, Medicaid and long-term care. Oftentimes we help clients shelter assets and strategically plan for the eventuality of long-term care. How does contributing to a 529 plan contribute to, Medicaid's long-term care program?
Well, 529 plans, they are treated as countable assets for Medicaid. So that means the funds are considered available to the owner to meet their needs, right? So what that means is you got to be really strategic about, planning for your future needs, but also, meeting your goals for, gifting and supporting your loved ones, right? So this is, again, where I would recommend you lean on professionals, right? You lean on your estate attorneys, you lean on tax accountants, you lean on investment advisors, right? And just help them, navigate some of the complexities associated with these rules. But also, it's a balancing act, right? You just want to allow them to help you, kind of build a strategy that works for you. Timing is really important in the client's circumstances on, when they want to start saving, and then when those distributions need to happen, plays a big part in this when you're doing Medicaid planning.
It cannot be understated the value or overstated the value of having all professionals on the same page, particularly as it relates to this work we're talking about. Mm-hmm. This has been great. We've covered a lot of information. I think as we close, if you don't mind kind of just giving some of the biggest mistakes that you've seen when it comes to grandparents who want to help save for their grandchildren's education expenses.
Yeah, so I would say just overall the theme is lack of coordination, right? So not coordinating with the parents of the grandchild, right? Number one, not coordinating with other strategies that you could use like direct tuition pay, and then not coordinating with your professional network, right? Your attorneys, financial advisors, accountants. It's always best, if you are trying to make a big change, change a beneficiary, take advantage of the 5-year election, do direct tuition pay. It's just always important to just loop in those professionals and just loop in, the parents of the child and just make sure everybody's on the same page.
Sure. Yeah, it seems like the key takeaway is, while we are all well-intentioned, strategy matters. And so making sure, like you said, everyone is coordinated on the same page is really invaluable when it comes to this type of planning. Kyle, thank you so much for joining us. If you don't mind telling our listeners where they can contact you and your firm.
Sure. So if you have any questions or want to learn more about 529 plans, please feel free to reach out. Again, our firm is called PKS Investment Advisors, and you can go to our website. It's pksadvisors.com, or you can send me an email directly. My email is kbanks@pkscpa.com. And thanks for having me, Katie. I really appreciate it.
Yeah, of course. It was our pleasure, Kyle.
Take care.
You too. Thanks for being us today on Off the Clock. If you'd like to learn more about us, visit our website at pwwlaw.com. Of course, you can contact us directly by calling 302-628-4140 or emailing info@pwwlaw.com. We're here to help you plan today to protect your families tomorrow. See you next time. Anything discussed on Off the Clock is for general informational purposes only and is not intended to create an attorney-client relationship. To obtain the most reliable guidance, listeners are encouraged to seek personalized advice from qualified professionals.